Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're glad you're joining us today. We're starting off with a story that's been making waves in the financial markets. According to recent reports, experts are weighing in on the potential impact of tariffs on the U.S. economy and the global market. Manish Sonthalia, a seasoned investment manager, shared his insights on the matter, stating that a tariff between 10% and 15% would be seen as positive for the markets, while anything above 20% or 26% would be viewed negatively. Sonthalia also expressed his doubts about the feasibility of a 200% tariff on pharma products, citing the potential adverse effects on the U.S. healthcare sector. He believes that such a high tariff would not be doable, and that generics are essential to the pharma industry in the U.S. The conversation also touched on the impact of tariffs on the U.S. macros, with Sonthalia suggesting that they may be doing more harm than good to the U.S. economy in the short term. He pointed out that the tariffs would ultimately be paid by American consumers, leading to inflation, and that the repercussions on the U.S. dollar could be significant. It's essential to consider multiple perspectives when evaluating the effects of tariffs on the global economy. While some argue that tariffs can help protect domestic industries, others claim that they can lead to trade wars and negatively impact economic growth. As we continue to navigate the complex world of finance, it's crucial to stay informed and adapt to changing market conditions. We'll be keeping a close eye on developments related to tariffs and their potential impact on the global economy. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we navigate the complex world of finance, it's essential to stay informed about the key players and their potential moves. Today, we're discussing a fascinating scenario that has the financial community abuzz: the possibility of Scott Bessent serving as both Fed Chair and Treasury Secretary simultaneously. Now, this is not just a matter of musical chairs in Washington. It's a development that could have far-reaching implications for monetary policy and the global economy. The idea of combining these two critical roles has sparked intense debate, with some arguing that it would concentrate too much power in one individual, while others see it as an opportunity to streamline decision-making and foster greater cooperation between the Fed and the Treasury. As we delve into this story, let's take a step back and consider the historical context. The Federal Reserve and the Treasury Department have traditionally maintained a delicate balance of power, with each institution playing a distinct role in shaping the nation's economic policy. The Fed, as an independent agency, has been responsible for setting monetary policy, while the Treasury Department has focused on fiscal policy and international economic affairs. However, in recent years, we've seen a blurring of these lines, with the Fed taking on a more active role in stabilizing the financial system and the Treasury Department exerting greater influence over monetary policy. This shift has raised concerns about the potential for conflicts of interest and the erosion of the Fed's independence. Now, let's examine the potential implications of Bessent serving as both Fed Chair and Treasury Secretary. On one hand, it could lead to a more coordinated approach to economic policy, with the Fed and the Treasury working in tandem to address pressing issues like trade tensions and debt management. On the other hand, it could also create an unprecedented concentration of power, potentially undermining the checks and balances that are essential to a healthy democratic system. As we consider this scenario, it's essential to remember that the global economy is inherently complex and interconnected. The actions of one nation or institution can have far-reaching consequences, affecting not just domestic markets, but also international trade and financial stability. In related news, Treasury Secretary Scott Bessent has been making headlines for his absence from key international meetings, including the recent G20 gathering in South Africa. This boycott has raised questions about the United States' commitment to global cooperation and its willingness to engage with other nations on pressing economic issues. As we move forward, it's crucial to stay informed about these developments and their potential impact on the global economy. Remember, my friends, that in the world of finance, nothing is certain, and the only constant is change. So, let's keep a level head, maintain our long-term perspective, and avoid getting caught up in the hysteria of the moment. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a closer look at the latest global market developments. As we've been discussing throughout the episode, the ongoing trade tensions between major economies continue to weigh on investor sentiment. Recently, U.S. President Trump announced plans to impose tariffs on Mexico and the European Union, sparking concerns about the potential impact on global trade and economic growth. The move has been met with criticism from various quarters, with some experts warning that it could lead to a further escalation of the trade war. In response to the announcement, the European Union has said it will extend its suspension of countermeasures to U.S. tariffs until early August in an effort to continue negotiations and find a resolution. Meanwhile, Germany's finance minister has called for firm action if the levies go ahead. Over in Asia, markets have been relatively calm, with MSCI's broadest index of Asia-Pacific shares outside Japan seeing only minor changes. The Japanese Nikkei, however, eased by 0.5%. In the U.S., S&P 500 futures and Nasdaq futures both dipped by 0.4% as investors await the start of earnings season. It's worth noting that while the trade tensions are certainly a concern, some analysts believe that the market response has been relatively muted. This could be due to the fact that investors have become increasingly desensitized to Trump's policy announcements, or it may be a sign that the market is waiting for more concrete developments before making any major moves. As we navigate these complex and rapidly evolving markets, it's essential to remain informed and up-to-date on the latest news and analysis. At the Riskwiser Zone, we're committed to providing you with balanced and unbiased insights to help you make informed investment decisions. So, what can you take away from today's discussion? Firstly, it's crucial to stay vigilant and monitor market developments closely. Secondly, diversification is key in managing risk and uncertainty. And finally, it's essential to have a long-term perspective and avoid making impulsive decisions based on short-term market fluctuations. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.